One way to help you get ahead financially and achieve your long-term goals is by building a portfolio of quality investments that work for you. To do this, you build a strategy and plan your investments in such a way that they earn maximum returns with a risk level that suits you. Passive and active investing are two main investing strategies for putting your money to work for you, but they differ in their approach and objective. So let's take a look at some of those ideas. Passive versus active. Passive investing can also be considered the hands-off approach. Passively investing in the market is about buying and holding an asset for the long term. You choose the stocks, bonds, or any other assets, and you hold on through various market conditions for a long time. These investors don't try and beat the market, they simply want to match its returns. While active investing tends to focus on individual assets, passive investing generally involves investing through index funds or exchange-traded funds, ETFs. Think of it this way. Individual stocks are the meat, milk, batteries, detergents, and cereal you buy at the grocery store. After you've filled your cart, that's all your groceries. In investing terms, you can call the full grocery cart a grocery index. In the same way, when you buy the S&P 500, you've just diversified your portfolio with pieces of some of the largest 500 company stocks. On the other hand, actively investing in the market means you frequently trade with the goal of outperforming the market. Active investors regularly opt in and out of trade positions and buy and sell stocks and other assets constantly. Hedge fund managers are an example of active investors. They monitor the market and actively make trades based on what they're seeing and hearing in the economic industry. They use high-level market analysis, experience, and expertise to pick the best time to sell or buy an individual asset to make a profit from short-term price fluctuations or market timing. Fees. Passive investing doesn't require daily attention since it's a hands-off, set-and-forget approach to investing. It's also a lower-cost investing strategy. Since passive investors don't enter and exit high volumes of trades, the associated cost of trading is also lower for the individual investor. Passively invested funds also attract lower expense charges as very little research and upkeep are needed. Their expense charge could be as low as 0.06% on passive mutual funds and 0.18% on passive ETFs on average. On the other hand, active investing attracts higher fees. They may need to pay higher management fees for actively managed mutual funds or engage in frequent trading, which can incur more transaction costs. Don't forget the additional cost of the research, analysis, and monitoring tools that are generally used. Expense charges alone could reach 0.71% on average. These percentages may appear insignificant, but the difference between 0.18 and 0.71 could mean thousands removed from your return in retirement. Risk. Passive investing is usually less risky, as this approach to investing is more fund-focused. When you invest passively, your money is spread across hundreds, if not thousands, of stocks and bonds. The good thing about this is that your portfolio is easily diversified. This comes with a decreased probability that the investment is going to drain your portfolio. Since your portfolio is exposed to a lot of stocks, the probability that all individual stocks are going to turn out badly is low. So even if a few individual stocks return negative, chances are other individual stocks within the index may balance it out. So while this strategy may not generate exceptionally high returns, it also helps mitigate the risk of underperforming the market. Active investing comes with both the potential for higher returns and higher risks. Since active investors aim to outperform the market, their success depends on their ability to make accurate investment decisions. But a lack of appropriate diversification and one bad stock could potentially wipe out entire gains accumulated over years, or investors can be exposed to the risk of underperformance, as active managers may not consistently beat the market over the long term. The point is that active investing comes with increased risk. Even though as an active investor, when you're right, you stand to win big, one wrong investment can drag down the performance of your entire portfolio with significant losses. Transparency. Using the passive investing approach, what you see is what you get. Passive investing usually has increased transparency. Because passive investing usually attempts to replicate specific stock market indexes, it will rarely hold investments that are not part of its named index. This means that if the specific stock does well, then you're sure its index will also perform well. But the opposite is also true. Now, with active investing, this level of transparency is not always provided. You don't get a mirror to compare your investments because much of your investment outcome is at the discretion of the investor. Average returns. Passive investing almost always provides a higher average return in the long run. According to the latest S&P Indices versus Active SPIVA report, over 90% of passively invested index funds of all sizes outperform their active counterparts over 20 years. One possible explanation is that active investing exposes the investor to trend chasing. They are more likely to be influenced by in-the-moment market trends. Consider the investors who followed the at-home workout trend and purchased Peloton at a high of $146 during the pandemic in 2021. As of the creation of this video in early 2023, the stock is below $10. As you can see from this example, the biggest issue with trend chasing is that you can't tell if a stock can still grow or if you're just at the tip of the trend. Advantages and disadvantages. Despite all these advantages passive investing has, active investing also has an edge over passive investing. First, a volatile market is flexible if you choose the active investing approach. In a volatile market, an active investor could move to a more defensive position, such as turning volatile assets into cash or bonds to protect his portfolio from further depreciation. With this capacity to respond to real-time market conditions, active investors may be able to outperform certain market benchmarks, like the S&P 500, in the short term. Because passive investing is typically done with a long-term perspective, it does not have an exit strategy in the event of a severe market downturn. You could argue that the stock market has historically recovered from every correction, but there is no guarantee that the corrections will be swift. This is why passive investors should periodically review and rebalance their asset allocation. When a passive investor does this correctly, his portfolio becomes more conservative as he approaches the end of his investing timeline. He recovers much more quickly from a market downturn this way. Second, with active investing, you have more trading options. As an active investor, you can generate windfalls by shorting stocks or hedging options, which increases your chances of beating the market indices in the short term. These trading techniques, however, have the potential to increase the risks and costs associated with active investing, and they are best left to seasoned investors and professionals. Now, there is more to consider than the high-level picture we've shown to answer the question of whether to invest actively or passively. In some market conditions, active investing could be more beneficial to investors than passive investing. For example, active investing may produce better results in a volatile or weakening economic market. Passive investors may benefit more when certain market indices pick up momentum and increase in value over time. However, in either market condition, there are no guarantees. And because market conditions change all the time, you'll need to be highly aware to decide whether to invest passively or actively. Passive investing can be a good option for individual investors, particularly those with limited money to invest. The last thing you want is to waste money on high-cost trading fees that result in lower long-term returns. Some of you may already be making passive investments as a personal investor through your employer-sponsored retirement plan, such as a 401k. If you don't already have one, a good 401k is the most convenient way to get started. So what's the answer to which is better, passive or active investing? As with many other decisions you'll have to make as an investor, it all comes down to your personal goals and priorities, but hopefully we've given you a few things to think about. Thanks so much for watching. If you haven't already, please like and subscribe and tell us below which strategy you use for your investing. See you in the next one.